Hey everyone, at a friend's request, I took a deep dive into ComfortDelGro Corporation, or CDG, one of the big names in the global transport sector. In this video, we'll break down how the company operates, look at its financial health, and explore what the future might hold for CDG. Let's get into it. ComfortDelGro is listed on the SGX under the ticker C52 and has a strong global presence, operating in Singapore, the UK, Australia, China, and Malaysia. The company's business is divided into a few key segments. 1. Public transport. This is their biggest segment, making up about 69% of total revenue through bus and rail services. The trade-off? Its operating profit margin is relatively low, around 4.2%. 2. Taxi and private hire vehicles. This includes their taxi fleets and other private hire services, which account for roughly 17% of revenue. This segment is much more profitable, with an 18% operating profit margin. 3. Inspection and testing services. Think services like VICM. Even though this segment only contributes about 3% of total revenue, it's the most profitable, boasting an impressive 30% operating profit margin. While Singapore remains the largest single market in terms of revenue, its share has been decreasing as overseas operations grow. The UK and EU, in particular, are becoming major contributors. In fact, while Singapore's operating profit has roughly doubled from $105 million to $210 million, its percentage share of the group's total profit has fallen from 86% to 65%. This is because the company's overseas expansion, especially in the UK, has become far more profitable. The UK's operating profit turned from a loss of $28 million in 2020 to a profit of nearly $50 million in 2024. This is a clear sign that the company's diversification strategy is paying off. So what's the outlook? The Singapore market is quite mature and saturated, with growth potential limited by competition from Grab, SMRT, and other operators. The company's future growth engine is clearly its overseas expansion. Overseas operations in the UK and Australia now account for almost 49% of the company's fiscal year 2024 revenue, reducing its dependence on Singapore. The company is also benefiting from higher margins on new UK contracts. However, this growth isn't without risks. A wider geographic spread exposes the company to regulatory, labor, and integration risks in the UK and EU. As investors, it's crucial to monitor how well the company executes on these overseas projects and whether these higher margins are sustainable. Let's look at the long-term trends of the financials. CDG has shown consistent revenue growth over the years, and its margins, while low since 2020, are slowly recovering. The return on invested capital, ROIC, is low, at about 5%, indicating that the business generates stable cash but doesn't create strong value. For income investors, the dividend story is compelling. The company has a dividend yield of around 5%, and its payout ratio of 75% is considered sustainable. Now, for the valuation, we ran a reverse DCF or discounted cash flow analysis. Based on the current share price of $1.45, the market is pricing in an optimistic growth assumption: 10% annual growth for the first 5 years and 5% for the next 5. This leaves almost no margin of safety. The stock seems fairly valued, not deeply discounted. So what's the verdict? ComfortDelGro is a defensive, dividend-paying transport company. It has a stable core business in Singapore and is successfully diversifying overseas, which is helping improve profitability. That said, at its current price of $1.45, the valuation assumes pretty optimistic growth, leaving little room for error. For long-term income investors, it's an attractive pick thanks to its steady cash flow and decent dividend yield. But if you're after big capital gains, it might be smarter to wait for a lower entry price, say with a 30% margin of safety, to improve your risk-reward profile. And with all the market volatility lately, we might just get that opportunity sooner than we think. And with that, we have come to the end of the analysis. Let me know what you think in the comments below. Thanks for watching. If you found this helpful, be sure to like, share, and subscribe for more in-depth stock analyses. Happy investing. Bye.